So in this video, I'm going to be talking about the price-earnings ratio. This is one of the most fundamental ratios when it comes to following financial markets, and you'll see this from a very basic financial course to on the job if you plan on working in the higher levels of finance. So it's a very fundamental thing, fundamental ratio, and it's used usually to value companies. And here's the sort of formula for it, and I'll go over what that exactly means. So the P/E ratio is literally, by definition, the price over the earnings. So the price of the stock over the earnings per share. So let's say to calculate this ratio for a single company, you could take its price, what it's trading in the market, divided by its earnings per share. And if you've taken some accounting classes, you know that the earnings per share is the net earnings of the company found on their income statement divided by their total outstanding shares. So sort of the earnings per share, price divided by that, and that will give you a sort of multiple. So why do we use this very, very important ratio? It's basically to give a quick and dirty, if you will, a valuation of a company. So let's say, we'll do an example here. Let's say you have company X. Okay, so we have a company X and we want to figure out its value, like what's its value, what's its stock valuation. And we want to do it really quickly, so we can use PE multiples, just multiply the earnings per share of the company by the PE ratio. But how do we get this PE ratio? Well, the mistake that most students make is we cannot simply take the PE ratio of the company that we're dealing with. That would simply just be a trivial identity. So let's say we want to determine the price. This is an unknown, we want to know what the price is. So we multiply the PE ratio times the earnings per share of company X. And that will give us the price of company X. But now, if we actually use the company's data, price over earnings, that won't really give us anything useful. The EPS over here, EPS cancel, and you just get price equals price, which doesn't really help us at all. So when we're using PE multiples, what we use are industry multiples. And what that means is averaging out the PE ratios of a bunch of companies within a specific industry. Let's say, for example, we take the tech industry. So let's say we're trying to value, let's say the company Uber, as I'm sure you all know, the ride-sharing app. So we want to figure out what their value is if they were traded on the financial markets. So let's say there are a couple of other publicly traded companies that offer the same services, something like Lyft. And of course, none of these companies are private. I'm just making up an example here. So we take similar companies like Lyft and a couple of other competitors. We calculate their PE ratios and we sort of average them out to get a single PE ratio for the industry. Once we have that PE ratio, we multiply that by the earnings per share of the company that we're interested in, and that will give us a sort of estimate of price of the company that we're interested in. So to quickly recap, PE refers to the price-earnings ratio. The formula for it is the price of the stock divided by the earnings per share, or equivalently, you can think of that as the market capitalization over the total earnings of the company. It's the same ratio. And you multiply that by the earnings per share of the company to get sort of a valuation or a price for the company. I'll be going over more of this ratio, the PE ratio and the market book ratio in future videos as well.